Hello and welcome to CMS Forex News. I'm your market analyst Nick Nassad. Today is Friday, April 24th, 2009. The Japanese All-Industrial Activity Index decreased 2% in February following a 1.7% decline in January. It's the fifth straight month that the measure of economic activity was lower. Japan's Corporate Service Price Index, meanwhile, fell 2.1% in March from a year earlier. The index, which measures business-to-business services, was up 0.9% on the month. Looking at the Aussie yen pair, the Aussie gave up part of yesterday's gains in the Asian session as stocks were down in Tokyo. However, after testing support at the 68.90 level, the pair reversed its earlier losses and tested the area around 70.30 for the third time this week. That level is a 61.8% retracement of the fall we saw on Monday. With the line of support sloping upwards, we are setting up an ascending triangle, and traders should watch for a breakout to the upside if risk appetite dominates sentiment next week. Stocks were higher in both Europe and in the US, helping to boost risk appetite for higher yielding currencies in today's European and US trading. The dollar-yen pair fared worse than the Aussie yen, as its 135 slide overnight to the 96.60 level saw only a 50% retracement. The Asian session saw the pair fall below support at 97.65, breaking out of a descending triangle that had been forming this week. Today's low is around the one-month low for the pair. The Greenback was pressured against its other key rivals today. Here we see that the Aussie-US dollar pair rallied about 100 pips, reclaiming the 0.7225 level, which is where the pair started this week. The Aussie managed to undo Monday's sharp 270 pip decline as better fundamental data from around the world helped spur risk appetite. Today's action saw a break of a recent resistance level on the back of an increase in risk appetite. In Germany, the IFO Business Climate Index rebounded from its record low of 82.1 in March to post an improved 83.7 in April. The index rose more than expected as interest rate cuts and government stimulus packages boosted the hopes that the recession will ease the rest of 2009. Still, the German economy is expected to contract as much as 6% this year. The euro-dollar pair, bolstered by 2 days of gains, rose another 160 pips today, testing the area near 1.33. This week's rally undoes the fall in this pair from last week. Better fundamental data this week from the Eurozone, including a better ZEW report, manufacturing and services PMI data, and today's IFO report, have given traders some confidence that the Eurozone economy may be stabilizing. The UK economy shrank by 1.9% in the first quarter, the biggest contraction since 1979, as the economy saw a sharp downturn in both manufacturing and services. On the year, GDP slumped 4.1%. The government sees its budget swelling as it spends to get the economy out of recession while tax receipts decline at the same time. Meanwhile, the central bank has embarked on a program of printing money and buying government debt, which has helped to stave off deflation. Hopes are, though, that the economy has showed some improvement to start the second quarter and that these results may prove to be the worst that the recession has to offer. In an encouraging sign from the UK, retail sales rose 0.3% on the month, beating forecasts that had called for a drop of the same magnitude. On the year, sales are up 1.5%, also higher than expectations. Sales of food and clothes were up, while sales of household goods continued to slump. Good weather, with the driest March since 2003, also helped to bring people out to go shopping. The pound-yen pair, a rally from yesterday, stalled at the 145.50 level, and from there fell overnight back to set a low at 141.15. Price action is showing the pair trading in a sideways range the latter half of this week. After a small rally to start the New York session, the pound fell again. The pound was pressured prior to its GDP data and again in New York trading on comments from the Moody's Investors Service that said that UK's finances are deteriorating rapidly. The euro's good fortune and the pound's troubles this week brought the euro-pound pair up to the 0.9080 level today, the highest the euro has been since April 8th. Since establishing support near 0.88, the pair has climbed 200 pips this week. In the US, orders for durable goods were down 0.8% in March, but that result was better than expected, adding to signs the economic slump in the US may be easing. However, the report also showed a sharp revision to February's data, with orders up 2.1% instead of the original 3.5% that was reported. A report on new home sales provided the market with better than expected news. First, the figure for March at an annual pace of 356,000 was better than forecast. It represented a 0.6% decline over February, but only because February's figure was revised up to show an annual pace of 358,000 compared to the originally reported 337,000. The median sales price has decreased 12% compared to a year ago, but inventories of unsold homes fell in this report to a 7-year low. Those conditions, plus the sales figures from February and March, should help to give a sense of stabilization in the new housing market. Since we have looked at most of our dollar crosses already, we will end today's broadcast with the US dollar-Canadian dollar pair. Like the Aussie, an increase in stocks and commodity prices today helped move the pair back to the 1.2070 level, which was lower than where the pair began this week. The loonie is also benefiting from Governor Carney's emphasis that even though he stands ready to deploy extraordinary measures, including quantitative easing, to help spur lending, he sees the current accommodative monetary stance as sufficient to support the underlying economy. Next week's key U.S. releases include first quarter GDP growth data, the FOMC interest rate meeting, and the ISM manufacturing index. Other key releases include the interest rate decision from New Zealand, German employment and retail sales, and GDP data from Canada. And that wraps up our coverage of the Forex markets for this week. Thank you for joining us here at CMSFX.com, and from all of us here at CMS Forex, have a great weekend.